Good morning, everyone. Thanks for joining us as we kick off day 2 of the ClimateCAP Summit. I am very excited today to have two amazing investment professionals here to teach the Beyond ESG Investing course. I am Megan Morris. I'm the Associate Director of the Sustainable and Impact Finance Initiative here at Berkeley Haas. Today we have Ann Simpson, who is Global Head of Sustainability at Franklin Templeton, as well as one of the instructors for our student-run investment fund, the Sustainable Investment Fund, and Peter Lupoff, who is partner of Beatrice Advisors, who is a coach of Berkeley Haas students. And so I'll just go ahead and turn it right over to Ann. Thank you.
So kind. Thank you.
Oh, well, thank you.
Good morning. It's lovely to be here. Peter and I are absolutely delighted that Berkeley's hosting ClimateCAP. Why? Because there's a lot for us all to get done. And we know part of what needs to be done on climate change involves every single person, as a consumer, as a voter, the things we eat, the way we move around, the choices we make in the voting booth. But we also know that money is an incredibly powerful source of influence, for good, for ill, or for something in the middle. And Peter and I both work in the finance industry, so our day job is thinking, where is the money? Where does it need to get to? Who does the money belong to? What are the objectives? And, some years ago, this acronym became popular, ESG, to stand for environmental, social, and governance issues. And there's a bit of an alphabet soup of different acronyms around, but we're going to talk about ESG this morning. But what Peter and I want to talk to you about is not just this acronym, politically correct, do the right thing. What we're really interested in is how the financial system overall can provide, I think, two things. One, the capital that's needed for the energy transition, but also, when we look at the question of who that money belongs to, we also need to start talking about accountability, because the force of finance is extraordinary, the potential of finance is extraordinary, but the big question is, who does this money belong to and who is making the decisions? So that's why the G in governance is just as important for investors as it is for the companies that we invest in. So what Peter and I are going to do this morning is a bit of a double act. I'm going to take you through a bit of a tour of the horizon, what's going on in this grand world of ESG, what are investors trying to do, what are they focusing on, and what are some of the results. We've also had a couple of questions in through the app, and I'll be able to answer those as we go along. For example, is this a way to make money, or is it just a way to have a bit more virtue signaling, which isn't going to get us very far. So I'll do that framing of what's going on and who's doing it and what some of the results look like. And then Peter is going to take impact investing, particularly within the Sustainable Development Goals, and look at real practical strategies and examples of what's happening there. So just before I begin, I should also say, I have a few slides, Peter has a few slides, but then we really want to make sure we're answering your questions and getting your ideas and input. Feel free to put your hand up or speak during the session, but we also want to have a bit of time at the end in case there's more. So first thing, how much money do we have? I mean, globally, all different sorts of finance. What does it add up to? Think about deposits in bank accounts, think about your pension, mortgages, insurance, real estate, mortgages. Just who'd like to have a go? How much money have we got? Yes, and please just give your name. So, Sumat, what do you reckon? 100 trillion? That's a lot. How much has Elon Musk got? Not that much. But Elon Musk has less than CalPERS, your local friendly pension fund up the road. So we get a little bit caught up in the headlines of what billionaires think, but the real money in the system is pension funds. The other big money in the system is sovereign wealth funds. So you're really talking about the financial system broadly is being financed by the savings of ordinary working people. So one way to think about this, and it's something I've written about with Satyajit Bose and Dong Gao, is starting to think about finance completely differently. Think about finance as our common wealth. And if we understand that, we can then enter into this discussion about accountability, saying our common wealth should be there to be deployed for the common good. Okay, so we've got the Sustainable Development Goals, and Peter will say more about that in a moment. Let's imagine we want to fully finance. We want to invest in everything that's needed for the Sustainable Development Goals, and several of them directly address climate change. As you know, there's number 13, climate action, but there are others that are relevant as well. What's the price tag? We've got 500 billion roughly in the system, so 100 was great. We're in trillions, not billions, but overall, a rough estimate, think of it, of about $500 trillion US in the system at the moment. How much do we need for the Sustainable Development Goals? Has anybody taken a look at the price tag? Yes?
Was it like 12 trillion?
No, you could have it twice for that.
Oh, nice.
Yeah. So, I mean, estimates vary. So let's say it's something between 5 and 7 trillion. And this is for investment purposes. You can then start to look at the 500. I'm obviously going to come to this in a minute. But I think often when we're talking about sustainability or climate change, there's a lot of hand-wringing, oh no, gnashing of teeth, rending of garments. We don't have the money. Well, that's true if you're a government. And if you start to look at the long-term investors in the system, we don't have a shortage of financial capital. And I think that's our first reason to be cheerful. We have the money. Then the question is, what do we do and how do we do it? So I just want to take you through a few slides. And at the end, Megan has put an email. If you want a copy of the slides, please let us know. Peter and I would be delighted to share them. So let me just say, okay, well, this is 20-odd years ago, 2006. The United Nations, no less. Who knows have you all heard of the UN? Yeah, okay. We are in America, but yes, the UN is somewhat important. Well, here's the good news. Back in 2006, 20 big investors, CalPERS, where I worked for many years, up the road, the California Public Employees Retirement System, friendly name, nickname, CalPERS. CalPERS was one of those funds. And basically saying the financial system has got to generate money for us to pay pensions. But also, hang on a minute, we now have so much money swirling around and we're investing in companies which are having a massive impact, not just financially, but on ecosystems, on society, on the economy. What are our responsibilities? And the UN consulted, as I said, Priya Matha represented CalPERS for this. And here are the 6 principles they agreed. And look at them, because they're pretty demanding. They say, first of all, we will incorporate ESG into our investment analysis and decision making. Secondly, we'll be active owners. We'll incorporate ESG into our ownership policies and practices. So if you make an investment in a company, that means you'll be voting your shares. If you're doing due diligence on a private credit security, you're going to be bringing this into your decision making. Thirdly, we'll seek appropriate disclosure. We'll promote acceptance and implementation within the investment community of these ideas. We'll work together. Is that breach of antitrust? Okay, we'll come to that in a minute because that's part of a debate trying to shut all this down at the moment. We will each report on our activities. So if you all go to the PRI website, it's a really wonderful resource because the investors involved they're required to produce an annual report explaining what they've done to fulfill those principles. So take a look, because it gives you practical insight into what's going on. Something a bit more useful than just following the headlines. So how has the financial market seen these ideas? They're bold, they're aspirational, They're way ahead of what anybody was thinking needed to be done back in 2006. But this is, I would say, second reason to be cheerful. Reason one, we have the money. Reason two, the financial markets get it. We're going to talk about some of the controversies in a minute. But right now, look at that. Just to your comment about how much money is there in the system, you said 100 trillion. 128 trillion are signed up to those 6 principles. That's quite inspiring. And where are these investors? Well, there's a good chunk in the US, but you can see these investors are distributed across the whole of the global financial market. So in other words, this isn't just a little pocket of do-goodery in Nordic countries. Robert Strand has done such good work helping us all realize what a good job the Nordic countries do. But to me, what's important, you have 140 investors in China, 130 in Japan, my country, the UK, but the US is the biggest number. Okay. I'm not going to go through these in detail. If you want the detail, send an email. But this is telling you what do we do to make sure that when we allocate capital, do we monitor what our managers are doing? Now, it might be a bit too far away for you to see, but what I think is important here is it's less than half. So you've got this big body of money all signed up saying, now we need to get things moving, but they haven't yet worked out how to implement the mandates and the reporting. So there's more work to do. However, when you do get stewardship organized, I'm using this example, one of the questions in climate change is, well, it's so big, it's so global, it's so complicated, can we ever make a difference? So I want to give you one example of where it is making a difference. I have a conflict of interest with this example. This is Climate Action 100+. This is an initiative that CalPERS set up when I was at CalPERS. What we did was look at the biggest, baddest, dirtiest investors in our portfolios. We found there were less than 100 that really mattered to global warming. And so these investors came together. I was the first chair of this initiative, so as I said, please, my enthusiasm is obviously influenced by that. But this is not our data. These are not our data. This is Bloomberg New Energy Finance. And what they took it upon themselves, well, is this making any difference? You've got all these fine words about stewardship. What is it really doing? So they looked at these companies and said, okay, climate action was formed on that date. Took a bit of time to get cracking and obviously have the conversations with the companies and get moving. These are the net zero commitments from those companies, which are now under pressure for reasons we can talk about. But those net zero commitments represent 25% of global greenhouse gas emissions. So a group of investors tackling a relatively small group of companies has got net zero commitments which are equivalent to the emissions of China, which is the world's biggest emitting country. So it can have an impact. There's other examples of what's going on with mandates, with integrating factors into selecting company investments or portfolio construction. Most are doing that. This is important because it's talking about what happens with fixed income. So you all are familiar with the idea of a stock exchange. That's equity listed companies. But those companies also have debt. And we think of that as fixed income. But governments and countries also issue debt. So fixed income is actually a really important area to be thinking about. So on this, you've got the reporting on selecting assets, on portfolio weighting, on holding periods, and obviously due diligence. And I just put one example here, which is from Ecuador, which is a debt for nature swap, because the context for this climate change, we've got geopolitical risk, we've got changing views, we've got lobbying, all sorts of things are going on. In the meantime, many of the countries that are vulnerable to climate change are under a burden of debt, which means it's hard when the interest payments on your debt can make it really difficult to pay for healthcare, for education. And then we come along and say, would you mind, by the way, just holding on to those forests, because we, the people of the world, want the climate change benefit of you not chopping that down. People say, hang on a minute, how do we earn an income? You know, this issue about understanding climate change in the context of poverty and inequality is really important, and Peter's going to talk more about that with the SDGs. This debt for nature swap basically was financed through private money for a bond in which the incentives for Ecuador were put in place to say, hey, you'll get this money, and it can in part be used to protect your rainforest. In other words, you're not having to trade off potential income of chopping things down and selling them. We're actually saying, no, there's another way for you to generate an income. And as the carbon credits markets of the world grow, there'll be more potential there. So this is going to be my final point. There's more slides looking at the regulatory developments, the geopolitical chaos, we might say. But the big question that we all need to address is, okay, we see the need, we see the money, we see what investors are trying to do, but will it bring home the bacon? Or I should, for the vegetarians, quote my own grandmother. She would say, fine words, butter, no parsnips. So just talking about something doesn't make something happen. Maybe it's just the first step. But what's interesting to me about this is the companies, which in this case MSCI is a big data provider, Henry Fernandez, he's down at the other place on the board there. Their data show this. Companies which are making progress on sustainability, and this holds true for developed and for developing countries, companies located there, their cost of capital is much better if they are reporting, even though the reporting at the moment is imperfect because we're still building out the mandatory frameworks. And that is holding true for equity and for debt. So you might like to look at that. The other thing in answer to the question on performance you might look at is Wharton has a very nice data lab, and what they do is look at operational performance and the impact of sustainability practices and policies. Okay, so let's wrap up. Regulators are wading in a big way, and I'm just going, this is a lot of fabulous stuff. I want to just leave you with this thought. One of the things in Europe that's going on is a big discussion about we need to make sure these strategies are going to generate returns for investors, right? If you're going to bring pension funds into this, they've got to pay pensions, so we need those returns. However, what the Europeans are also thinking, well, sure, but investors are not the only group that matter. So something which is something that matters, the word that's used in finance for that is materiality. Is it material? There's different ways of judging what might be material, but does this matter to me as an investor? That's a test of materiality. However, what if something really matters to a local community, to a First Nation, to workers, to people in the supply line? So the Europeans said, yeah, we get that. We're going to call it double materiality. We want companies not only to report on their impact for investors, because we're providing the capital, we want to know, you also have to, in Europe, they've introduced a framework by which you have to report on your impact materiality. And that's something Peter is going to talk about more in depth. Okay, I leave you with this example. So for CalPERS, it's the biggest pension fund, defined benefit pension fund in the country. When I left, it was $500 billion portfolio. 56 cents on every dollar that CalPERS pays out comes from investment returns. So that poses the question that the phrase or the acronym ESG has got a bit missing. And I have long said, asked the question, where's the F in ESG? I know, people thought I was swearing the first time I said that, but I really, really am not. I'm too old on that generation that doesn't swear unless you drop a brick on your own toe. And then I'll say, oh, drat. So what we did at CalPERS, and this is the model we're using increasingly at Franklin, is say, thank you, ESG. We want to go beyond because we don't have the F for finance at the heart of the model. So what we've done to get to sustainable investment, say, hey, you need financial capital, right? This is the people's money, the commonwealth. But then you've got to think about the natural capital that you need to manage. Think about biodiversity, water risk, think about the big climate change issues of the day. And then human capital, the people in the business, the people affected by the business. So this model of the three forms of capital is where we are, I think, in the big investor community going towards. So along the way, as in any complex process of change, there are legacy issues, there are vested interests, there are challenges, and it could not be more complicated or important to get done. So the fact that all of you are here at this event, that ClimateCAP is happening, is really my third reason to be cheerful, because this will be the issue of the day wherever you're working, in investment, in business, in policy, in the arts, wherever you're going to work, these are issues that are going to matter. So thank you for getting up early on a Saturday morning and coming back. But let me hand over to Peter, because he's going to give you some really wonderful insight into the impact investing piece of all of this. So, Peter, over to you.
Awesome. Wow. I can never spend enough time listening to Anne and asking her questions. And one of the formats I first thought would make sense was just sitting together and having a conversation, because when we sit together and talk, I always learn stuff. So that was terrific. It was terrific. First, I want to talk a little bit about some of the things that Anne mentioned about the framing. So if you think about the world's wicked problems, you could break the constituents into 4 boxes. You've got all people, that's really freaking powerful. All people. You have business that you'd like to think you can nudge as a force for good. And why might you? Well, you might because all people, or many people, work in those businesses. So those businesses could reflect the values of all people. You have the capital markets, which is completely agnostic, right? The capital markets will give people what they want. They'll build products that serve their needs, that serve business needs, serve investor needs. So if all people are driving business as a force for good, the capital markets will provide those kinds of products. There's a 4th quadrant that is the most dysfunctional aspect of that, and that is governance. That is politics, that's leadership, that is short-term thinking, is for sale, and always has been, maybe can change. But you would think that all people on this planet have enormous power, to your point, that we can drive the outcomes that we want. About the current climate that we're in right now, one of the things I say to students frequently about it is like it could be that the way out is through. We just really need to kind of a foot ahead of the other. Let's continue to do the good work we're doing and not be dissuaded from the noise of the moment. As my 18-year-old son likes to say, Dad, eventually old white men die. So, how's that for wishful thinking? But, the thing is that $82 trillion changes hands intergenerationally over the next 20 years, first to women and then to a next generation. And the psychographics of those communities show that they're predisposed to care how money is made, not just that there's profits. So, it could be very well that time is on our side in terms of right outcomes. Time may not be on our side with regard to climate solutions. That's a different foot race. But I remain hopeful about the prospect of all people driving better outcomes. So that's why I've gone 20 or 30 years in traditional investing and moved my way into impact investing, sort of seeing the light. And like a sort of reformed smoker, I am now a zealot about that. So these are like the nomenclature. This is some nomenclature of like the way people are coded as investors. And you shouldn't get too lost in these definitions. I just use, because they change all the time and academics will quibble about this sort of thing. But you could think of traditional investing or investing without considering the impacts money have on people and planet as being traditional or amoral. And I mean no value judgment in that. It's just that stewards of capital are not considering anything than, Milton Friedman's shareholder primacy, that the purpose of business is to create the highest returns for shareholders. Socially responsible investing is sort of an older term, and the industries are looking for jargon, and maybe, frankly, because people want to attack acronyms, better not to have jargon at all. But to invest, say, the way that Anne has talked about, through lenses, ESG lenses, for those companies that can generate the best outcomes around environmental, social, or governance. You could create screens around that to ring out industries you can't abide by. You could have more higher intentionality through public markets by engaging, as Anne mentioned, the Climate 100. You can engage companies and seek to affect change at the corporate level. Because, the building of a portfolio for an individual, for a family office, even foundations, endowments, it's not particularly... it's not an effective tool to have everything in high risk, high impact, long-term locked up structures, which I'll get to in a moment. So you're probably looking at portfolios that have public securities, the equities and fixed income of public companies, some amount of investing perhaps in social enterprises, which I'll talk about, businesses that have wired into their resolutions social or climate-related impacts that they seek, along with financial returns, or funds that will be the way you pick up a portfolio of those kinds of companies. So impact investing I'd call targeted, because you're targeting specific impacts along with your financial goals. And there are investors in the impact investing space that care about financial performance first. There are those that care about impact first. Sometimes that's a function of how permanent that capital is, and if it's through, let's say, a foundation where there's a corporate charter about the impacts they're trying to achieve. Anne mentioned the F and ES and G, and I'd also say there's the P part, which is performance. In this time and place, it's probably much easier for impact managers and impact investors to talk about the enormity of the opportunity set that's out there. The money that could be made is a more powerful way of disarming the politics of what you're choosing to do. I've told some investment managers, like, when you don't lead with the impact, lead with the enormity of the opportunity, the returns that you're projecting. And if your potential investor says, well, where's the measurable impact? It's like, oh, yeah. We'll get to that in the addendum. We have all the slides and the measurability. Where impact investing sits in sort of this continuum, I think of it as a continuum as a function of liquidity and what I call intentionality, and that's like, what are the measurable impacts that can be derived for the dollars invested? I think of it as like a continuum that runs from highly liquid investments in public securities, where the impacts are nudges in capital markets. That's really powerful, not to underestimate that. Anne may know the statistic better than me. It's like 1 in every $4 in the world on the way to 1 in 3, even with this slight dip that's occurred in this current climate, that's, 1/3 of all capital on planet Earth is investing, considering environmental, social, and governance. That's going to have cost of capital issues for those companies that are not good performers through that lens. But there are the nudges that, there's also the nudges that come from shareholder engagement that Ann mentioned. You go out on the continuum a little longer if you want more heightened intentionality, you want real, genuine, measurable social or environmental impacts that come from your dollars invested along with the financial return. You're probably talking about locking up your money for longer term because that's how you're going to get it. You can't have that liquidity in investing, where with public securities you can buy or sell those securities, be in and out of them, and get cash or be out of cash in 3 days. It's the way public markets work. If you're investing in a private company that identifies as a social enterprise, it has wired into its DNA social or environmental impacts, those are not particularly liquid investments. So you need to believe in the financial prospects, but also that they'll get to the measurable impacts. Or the funds that might invest in them, if the underlying investments are a pool of small companies, let's say it's an impact-oriented venture capital, like a green tech venture fund, the underlying investments in that portfolio are those small social enterprises that are not particularly liquid. You need outcomes. You need exits in order to have liquidity. So those are 7, 8, 9 years that money is locked up. And depending upon the way you build your portfolio, there's some portion of money for most institutional-sized and even individual investors that can be longer term, so long as you have your liquid side as well. So the way most impact investors and social enterprises that would consider themselves impactful will deliver you the measurability will be through the lens of the SDGs, the UN's Social Development Goals. 2015, I'm sure you've seen variations on this slide before. It might be hard to read, but you probably know all the SDGs, or you could look at them, look them up. In 2015, 191 countries, including the United States, agreed to 17 Sustainable Development Goals. We're not making great progress, though. We're 2025, and the goals were to be achieved by 2030. So it's going to be a hard slog to get there, but it's important to have those objectives to set a bar. This is the way the 17 might divide based on environmental, social, and governance. And then, that's probably hard to read, I apologize. If you were to have an investment or a fund that would map to SDGs, these are some of the outcomes side by side with the SDGs that they would be delivering to you as part of that. So if you were to take, let's say, SDG 6, which is about clean water, your fund manager that is investing in delivering outcomes under SDG 6 or the social enterprises you might invest in would be giving you measurable outcomes related to access to water and sanitation and efficiencies. And I'm going to flip ahead for a second. That's really hard to see. I apologize. This is a, this is an impact investor. This is K.L. Felicitas. I don't know if anybody know Charlie and Lisa Kleisner, those names, or K.L. Felicitas. They produced a report for how their family office was measuring the impact of their investments, and it's in the public domain. You can Google it and find the PDF and take down the whole thing and see it yourself. But if you looked at, this is the list of the funds that they're invested in across the 17 SDGs. And if you were to look down SDG 6 that we just looked at about clean water and sanitation, you'll see where they're picking it up. But you'll also see that there probably isn't there are very few investments you make that are purely going to be one SDG. You're going to pick up others. It's not like that's a bad thing, right? That, you've got a BIPOC or woman fund manager that's doing a climate tech solution, so you're picking up intentionality around being a capital provider to an underserved GP, and you're picking up SDG 6, so you're picking up a couple of different things in that. But, the way money is allocated privately for more intentional investing comes in a couple of different structures. One would be through enterprises, as mentioned, social enterprises. They may be B Corps, but typically they will wire the impacts that they want to deliver to investors in resolutions and will report that along with the financial returns. They'll have what they'll call a theory of change, which is what about their mission that they see is unique, distinctive, and is going to create the outcomes, the social or environmental outcomes that are desired. And frequently they're doing that by either providing products that are wanted in markets, providing products to underserved communities. These companies have outcomes where their takeouts are frequently, other funds will buy them, and they could go public. It's a different topic to talk about the IPO market, because the IPO market is kind of non-existent right now. So I think that there is some issues about investing in private companies about what the long-term outcomes are. Not to go down this rabbit hole too deep, but one of the answers is, well, there are other solutions to returns that also might convert private companies into employee-owned businesses, so you can get myriad other kinds of impacts. One of the things that I like to say, particularly to really rich people, is how much is enough, right? So if you're going to get, the S&P delivers 11% returns, and a portfolio across public and private obligations and LP stakes gives you 9 or 10, you have room in your portfolio for some things that are more highly intentional and provide heightened impact, because you're going to be offset by other things. And, if you're not running money for other people and it's yours, you can make the decision that an investment benchmark might say that you should be making 10% and you made 9, and you might say that's good enough. I'm not going to live in a refrigerator box, right? This is a good enough return for me. So I think we're finding that generationally too, as money finds its way to the next gen, and we're going to see more flexibility and latitude in the kinds of return characteristics people will ask for. That's one of my hopes. There's impact funds. So these funds are the ones they'll buy those social enterprises as part of a venture capital fund, as part of a private equity fund. Infrastructure funds might fund projects. All these are delivering measurable impacts along with financial returns. Similarly, they'll have a theory of change. The structures are typically limited partnership structures, not to get too wonky. So there's a partnership vehicle. The manager is a general partner of that, and all investors come in as limited partners. If there is a problem in the democratization of impact in this regard, it's that frequently there's a high minimum dollar price. There's SEC regulations around the amount of capital an individual can have to participate in these kinds of structures as well. So there are some limitations on who can invest this way, that the market is also trying to figure out ways to create opportunities for smaller denominations to be held. There's still long-term holds. For example, an infrastructure fund might be 11 or 12 years. You might get returns of capital along the way, but it's your capital is also a call on capital. As they buy deals to put in their funds, your $1 million commitment, let's say, will have a series of what are called capital calls, where over that 3 or 5 years, they're taking money from you. They're informing you, we need money. And then in the last few years, there's what's called the harvest period, where they're working those funds, they're working out those businesses and selling them or selling them back to employees, selling them to other funds, selling them in the public markets. And then there are really long-lived assets, like real assets, forest, farmland, affordable residential housing. These are going to be longer time periods. The affordable housing kind of product will have potentially cash flows back to you, so they feel like an income-producing kind of product as well. And there's a movement afoot that we've been working with to create a market in what's called natural asset companies, NACs, which would be you drop large tracts of land into a public vehicle. That public vehicle, like a share of stock, can trade, and in the ideal world, you have people closest to the land. If it's native territory, tribal territory, then tribes would run, at least in the example I'm working on right now, would run large tracts of land as stewards of that, and the intrinsic value of the land is technically the net asset value of that company. That's a kind of a coming frontier product idea. There's these performance model or social impact bonds, which are similar to a fixed income product that Anne mentioned, in that there are bonds with, this is sort of where it merges, where you can own a fixed income product that looks like a public security, but has, as part of its use of funds, a social or environmental impact. And the return characteristics are usually a function of how well the theory of that bond issue was in delivering that outcome. The famous example is the Peterborough bond deal, which was a bond deal done outside of London. It was 140 million pounds. That was an anti-recidivism bond that said, well, this bond is going to retrain the previously incarcerated, and if incarceration rates and recidivism rates reduce, then the coupon paid is higher because the municipality has lower costs related to maintaining jails. So that's the example that many people use. I think, unfortunately, there's not a lot there. There's not as much there as could be done. But that's where you get a little bit of a crossover, that you have heightened measurable impacts attached to a publicly traded structure. So again, this is a family office, the way they've described their funds by SDG. This is the text portion of that same SDG 6, where they talk about the actual measurable impacts they picked up by investing in those funds for clean water and sanitation. 633 million liters of water purified in 2016. 1,100 active toilets, 2,400 tons of waste safely removed and treated, 69,000 acres of freshwater bodies and wetlands protected. They coded them to the actual SDG bullet points and then listed the fund managers that have done this. They're reliant on the fund manager giving them back the data to incorporate this. So this is how that family is saying, yes, we're getting the measurable impacts that we've identified. This is one fund manager's slide on the way they would describe to a potential investor the measurable impact that came from an engineering tool that architects could use that significantly reduces greenhouse gases in the design work and manufacture of real estate buildings. They claim that the impact is 27.6 million CO2 avoided, but what we see here is a simple representation. The devil in the details is whoever the investor is, whether it's a fund manager or it's the family, you need to ask the fund managers or the companies for the measurable data. I'll ask just one sort of question to the room, and then maybe we should do some Q&A, which is, what do you do? Like, if there's a default on a bond or a company goes bankrupt, we know there's a problem. What do you do when you invest in a social enterprise or a fund manager, and you're doing it for the long-term lockup or long-term measurable social or environmental impact along with financial returns? And they deliver you the financial returns, and they can't demonstrate that they've delivered you any of the social or environmental impacts. This is a kind of a conundrum that you've now committed to long-term money being invested, and you really need to work with them to nudge them to help the business plan change or their measurability change, is what I call like sort of an impact default. What if you have great financial returns and you're not getting any of the impacts, but you're locked up for 7 years? So these are some of the conundrums that come from doing sort of longer term, more intentional, long-term impact investing. Let's open it up to Q&A.
Thank you. For Q&A, I'd love to start, not surprisingly, a lot of students in the room are thinking about how to break into investing careers. Impact investing can be pretty difficult to break into. Will be graduating in 1 to 2 years. So do you think there's going to be an increase of growth opportunities in the impact space? And what specific skills do you think students should be focusing on while they're in school in order to secure a job when they're outside of school?
Yeah, probably both of us, because we work in different parts of the industry. We've got some insight to that. Number one, if you take that final model, I was saying, beyond ESG, where are we going? We're going into this idea of managing different forms of capital. You cannot be successful in this area unless you do your finance. If you don't understand the financial capital piece of this, it's going to be difficult for you to get a job which allows you to think about natural capital, which might be where your heart lies, or the human capital side of it. People, as Peter was saying. I'm more in the economist end of life. People, human capital. But that we know this is people, each other. I don't mean to diminish that. I think when I first went into the industry, I was in my mid to late 20s. I was in London, and investment management wasn't even regulated. Think about that. This is 1988. Europe forced Britain to start regulating. And they had all these people doing investment, me included, and they say, well, who trained you? Who gave you the qualifications? So they had to go through this very rapid thing where I say, well, you have someone to recommend you, and we'll have an interview, and that's all changed. Get your CFA, do your finance classes, do your portfolio construction. If you understand the financial piece, you might end up working for a family office which says, we are happy with concessional returns. We're not just, barging through this trying to make as much money as possible, as Peter says. However, most of the money has liabilities attached to it, back to the big money as pension funds, sovereign wealth funds. So you're going to have to understand how to generate the financial returns. And then the great challenge is going to be the human capital and the natural capital. What will be a real strength is if you understand the interplay between these three. That is, if you look at that 128 trillion of investors, in the industry saying, hang on, we need to get this stuff integrated. We need to take responsibility for all of this. But we can't trade off the returns. So I would say this is a question for heart and for head, but make sure you know the skills and the analytical models in finance. And certainly at Berkeley, I know that's something we focus on. We don't just teach sustainability as a marvelous thing. We want to make sure you've got the tools, the analytical models, the training on finance, so that you can go into any finance job and be transformative in that role. Because there's no job in finance where you can avoid thinking about this stuff. Even if you go and work in coal investments, you're going to have to think about environmental issues. No escape from that. Peter, what do you think?
Yeah, I totally agree that you need the academic underpinning around finance. In the specific impact space, the more intentional side, it's interesting. I always describe to students that there are people that originally came to it from sort of the do-good world. I think we came from the do-well world. We were both in markets, and we found our way.
I'm a lapsed Catholic. I came from... I'm not going to hell. I don't believe in hell anymore, but something... How do you ever get rid of the idea that we have a responsibility to each other? It's like, read your Kropotkin, read your psychology. As a species, our ability to cooperate is our superpower, and we forget that. So I actually think that doing well... Actually, Benjamin Franklin, I work for Franklin Templeton, actually said that. He urged the American people to do well by doing good. Yeah. And he started that good advice, 300 years ago? So yeah. We're still at it, Peter.
My point, though, is that the impact space really started with people that came from the do-good world. They really understood the issues. They didn't have the financial underpinning. And then what we saw in sort of 2010 through 2020 was backfilling with younger people that had the skill sets, or people that saw the light and came with skills from other places. So this is a first generation that can come through academia wanting to do well and do good because they have the financial acumen and they understand the issues.
Agreed.
Most of us had to backfill one side or the other of that. So there's that. And then the second part is, in the impact space, the measurability side of all of this is still just sort of Wild West. And so to the extent that there's innovations there, it could be really, really meaningful. And, there could be, valuable or not. And many people, practitioners, might not like where the industry goes around measurement. There's always going to be disagreement about. But innovation there is potentially something that could unlock more dollars if you could find ways to give companies more comfort that they're rated ratably to people in their industries. There's movements afoot through various accounting groups.
Well, that's just such a great point. I didn't spend time on the slides, but we're on the brink of a reporting revolution. Quietly in the background, the accountants, remember those people? You thought it was a dull job. It really isn't. Accounting is a fantastic profession to get into at the moment if you're interested. I would also say audit. Some of the traditional professions where you think, I care about the world, I care about people, I'm going to be an accountant. That's actually would be a marvelous next step, because how companies report on these issues, as Peter said, you say I'm doing all the right things. How do you know?
It's noble. Noble. The word count is an accountant.
Sorry?
It's a noble profession. The word count is in.
Indeed, and it's the root of accountability, which is a principle that really matters to all of us. So what's happening is the International Financial Reporting Standards. That's the world's accounting rules. In Glasgow at COP, they launched a sustainability section. I sit on their investor advisory group. They have got over 50, they're up to about 55% of global GDP is agreed to report into this sustainability framework for public markets. They have also been coordinating with California and New York, which we know the SEC will not be following up on this stuff anytime soon, but the states are bringing this forwards. And in private markets, as Peter said, where it is all a merry chaos, there's initiatives like the Institutional Limited Partners Association. They've just signed a memorandum of understanding with IFRS so that we're slowly seeing consolidation on sustainability reporting. Imagine if companies have to report on their climate risk, their health and safety, their biodiversity, their freshwater risk, then investors are actually going to have the missing link. So I think despite the geopolitical pressures, despite being in the wake of COVID economically, this reporting framework is going to deliver something very exciting. So be an accountant.
Thank you. And we could have, of course, Q&A go on for a whole nother hour, but we only have 4 minutes left, so we're going to do sort of rapid-fire answers to get in a few more questions. We started looking at the UNPRI principles, but who is actually monitoring these companies to see if they're upholding commitments principles, and are there consequences for violating that?
Yeah, I don't know if there's time to flip back to a slide I missed. It's a map of global taxonomies. Stop. There we go. Thank you, Megan. What this shows you is right across the world, regulators are having exactly the same question as you. They know, ever heard of snake oil? Right, the idea that something is sold to you. There's even a film that's just come out called Apple Cider Vinegar, which is the new snake oil, apparently. But ESG was given that label. This is snake oil. You say you're going to cure ills, you're going to do good, you're going to make money and save the planet and be kind to people. How do we know? And regulators are saying, hang on a minute, if you're taking money off the public through their pensions or their savings, or, I mean, ordinary people as well as the family wealth officers and the rich people, but everybody, the everybody people, regulators want to make sure that you're being told the truth about the investments, like the idea of true and fair in reporting is essential. And regulators have started slapping big fines on fund managers who've been marketing products that don't have the impact that they're claiming. So there's snake oil, I think, is being flushed out of the system by the regulators. The question is, investors need this high-quality, reliable, timely information which has been audited, third-party verified, all that good stuff, and we're just on the brink of getting frameworks to put that in place. So it's still a little bit the Wild West, as Peter said, but big changes are coming. And trust but verify, isn't that the theme? Which is an old Russian proverb, actually, which Ronald Reagan was taught by his translator when he was negotiating in another era with the Soviet Union. Trust but verify.
Thank you. And for our final question today, of the 5 to 7 trillion that is needed to reach the UN's climate goals, how much would you say is 1, an attractive financial investment today, 2, will eventually become financially attractive as technology progresses, and 3, unlikely to ever be financially attractive?
There is a piece that will never be right for the private markets. Then there's a piece, which, as Peter was saying, there is a section of the financial markets which is willing to put money forward at concessional rates, not just family wealth officers, but the international development banks, the African Development Bank, the Asian Development Bank. And then there's the CalPERS, the big pension funds. So we've got to put food on the table for pensioners. We've got to optimize our risk-adjusted returns. So think about those 3 categories, those who must have the money, those who will be able to offer a bit of subsidy, and then some areas which are going to have to be publicly financed. So one of the things I'm doing at the moment, and if any of you want to find out more, be happy to follow up, is I chair a transition finance working group, wait for it, for the Official Monetary Financial Institutions Forum, that trips off the tongue. But the idea of this is to say, let's divide up the projects into these 3 categories. Then let's work with the development banks to get the concessional finance in. So we know that we can do a capital stack, a layer cake, if you like, where you've got your first loss risk, your commercial risk, and public sources and philanthropy can actually come in. And that term has been called blended finance, but it hasn't moved much money. So we're now changing the language, saying let's call it catalytic finance, because we want the concessional money to really catalyze private money to come in big time. So that work is underway, and I think it's very exciting. There's a lot of possibilities.
I think there's a movement afoot in private markets to really jumpstart the idea of catalytic capital too. You'll see like a Ford Foundation or Kresge Foundation, an entity called C3, which is, who was that against? MacArthur, Rockefeller, and Ford, I think, that will come in, and the way this catalytic capital works is they'll either be the first loss on investments that will crowd in a tranche of money that has higher upside, or they'll take much lower returns than would be market for that risk. But there's a writer and thinker out of the UK, John Elkington, who wrote a book called Green Swans, which is about the exponential outcomes that come from investing in new technologies and outcomes that will improve the world. And you know, some people think that risk is one way. There's the risk that you lose money. There's the risk that we don't invest in unique opportunities that could really make these, could make for tremendous outcomes. So the exponential green swans that could come from investing in venture capital that might have green solutions to help make for better climate solutions going forward. I think that's where next generation can really make a difference, is to hasten change by getting young change makers in positions to deploy capital this way.
Well, that's a very inspirational point to end on. So let's give a round of applause to our speakers.
And a thank you to our signers.